Ladies and gentlemen, please welcome Mr. Douglas Peterson, the President and Chief Executive Officer of S&P Global, to lead a session on economic trends and opportunities in the U.S. Joining him are Mr. Brett Himbury, the Chief Executive Officer of IFM Investors, and Mr. Scott Kupor, the Chief Operating Officer and Managing Partner at Andreessen Horowitz.
Thank you for the invitation today to share some time with you talking about some of the key aspects which are making the United States an attractive market for investing. We're going to spend some time this morning talking about some of the conditions of the financial markets in this country and some of those in particular that make it an attractive market for different types of investors, venture capital, pension funds. We'll look at infrastructure. But let me start by introducing myself, and then we're going to go down the line and each introduce ourselves. My name is Doug Peterson. I'm the President and CEO of S&P Global. S&P Global is an information services company providing debt ratings through our credit rating business, providing information that you know very well every day when you watch across the bottom of television screens, the S&P 500 and the Dow Jones indices. We also have other businesses, in particular recently been looking at infrastructure as well as ESG and green investments because they're becoming very important topics on a global scale. But let me pass it on down the line.
Thanks, Doug. Good morning, all. I'm Brett Himbury, the Chief Executive of IFM Investors. IFM Investors is a global institutional funds manager. We are owned rather uniquely by some 28 Australian, what we call superannuation or pension funds. Our investments in this country at the moment include the ownership of the concession for the Indiana Toll Road, the Colonial Pipeline servicing the east coast of the United States, and in the process of constructing a LNG gas export facility in Freeport, Texas. We also invest money on behalf of around 70 US public pension funds, including the VRS, the Virginia Retirement System in this state, as well as, of course, for many of the Australian industry funds who have been pioneers in things like infrastructure investing.
Great. Good morning, everyone. My name is Scott Kupor. I'm the managing partner for Andreessen Horowitz. We are a venture capital firm based in California, roughly about $6.5 billion of assets that we manage traditionally on behalf of endowments and foundations and other institutional investors. Our job is to find very interesting and innovative entrepreneurs who are doing cutting-edge things in all areas related to computer science or software-based businesses and looking to apply the application of computer science to, in many cases, traditional industries like transportation or finance or life sciences or other areas. Some of the companies that you may have heard about that we've invested in over time include Lyft, which is a ride-sharing service here in the U.S., Airbnb, which, of course, is a global hotel and places inventory, Facebook, among others. So we appreciate the opportunity to be here this morning and look forward to talk to you about more things on venture capital.
Great. Thank you. As you know, one of the aspects that make the United States markets quite unique is our capital structure, our very deep, very liquid, complex capital markets, which provide you different aspects to finance companies and finance projects. We have some expertise here today that we're going to explore some of those ideas. But let's start with the venture capital end. What are some of the characteristics that make venture capital special? And why do you think the United States is a market that has become so well known for venture capital?
Yeah, I think what's happened in the U.S. really over a period of about 40 or 50 years has been a willingness and an opportunity for financiers to take risks on entrepreneurs, and then certainly for entrepreneurs themselves to be willing to, quite frankly, risk it all in order to try to build new businesses. And one of the things I think that's worked in the U.S. quite well is a cultural willingness not to praise failure, but to understand that in the process of creating new companies, there often will be failures. We were talking backstage a little bit. If you think about our business, about half of the companies that we invest in, we will lose either all or a significant portion of our money. And the way this business works is there's hopefully a small portion of our companies that ultimately can go on to be very large businesses like a Facebook, like an Airbnb, like a Twitter and companies like that. So the whole business works around this promise that Not that we are trying to, be concerned about the opportunity to take those risks, but a willingness to take those risks, and quite frankly, understand that in many cases, in the process of trying to create companies, unfortunately, failure is an often path that we go down on these businesses.
So, Brett, I imagine if you're managing funds on behalf of your investors and your shareholders, I don't think pension funds would only be losing 50% of the investment. So what are some of the characteristics of pension investing, and what are the ways that you think about the fiduciary responsibility you have for your kinds of investors, and what are some of the characteristics that you look at for running your business?
So, come back to first principles, you're right, Doug. We ultimately represent pension funds in this country, pension funds in 14 other countries, of course, including Australia, around the world. So those people, and people like me, invest in their public superannuation, their public pension fund. They simply want to get to retirement and be able to afford it. So their return expectations in aggregate is, inflation plus 4%, inflation plus 5%. So we are looking to match the liabilities and the expectations that they have with, strong, stable, relatively secure assets, in particular infrastructure. The other thing I should also say is that in representing workers' capital, we believe the way in which we can give ourselves greater confidence that we'll generate that sort of return is that we'll take an active involvement in the actual management and ownership of the company. So, and in so doing, we'll improve the enterprise value by creating more jobs, improving safety, and adding to the communities in which these infrastructure assets are serving, a vital purpose. In so doing, you're creating a more prosperous, community, which in turn is contributing to the revenue of the enterprise, which is contributing, therefore, to the returns to our underlying workers, which is the capital that we represent. So it's a nice virtuous circle, adding to the returns, but adding to the prosperity of the communities.
You mentioned infrastructure. In another role I have, I'm a co-chairman of an executive council at the Bipartisan Policy Center to look at ways to foment and encourage infrastructure investment in the United States. The Civil Society of Engineers says that there's a huge opportunity in the United States for upgrading our infrastructure, whether it's roads, it's ports, it's airports. The rail system is in generally pretty good shape, but across the board, there's a lot of opportunities in infrastructure in this country, and ways that the federal government, that states, cities, et cetera, can make it easier and make it faster to be able to realize this opportunity. You have actually lived some of those opportunities, and you mentioned in your opening comments that you have investment in the Indiana toll system. Why don't you tell us a little bit about that investment, what it's meant, what are some of the characteristics about the investment, and how well it's gone for you?
Sure, and just to the first point that you also made around the infrastructure needs of this country more broadly, and I'll certainly come to the Indiana Toll Road as what we believe to be a great case study. There are, in essence, three core strategic issues that this country and many other countries face. That is, you want to elevate growth, and at the moment it's running at sub the long-term average for the United States, which is closer to around about 3.2%. So how does the administration and others get the growth rate up when fiscal and monetary policy is otherwise quite constrained? Then to your point, Doug, there is clearly a massive infrastructure funding gap. It's estimated to be around about $2 trillion. And again, the administrations that have normally funded that are constrained in their ability to invest in that $2 trillion. And then the other perverse thing is that you've got the pension fund system in this country, a lot of which is defined benefit, that have got a funding gap that's estimated to be about $1.2 trillion. And in a low return environment, it's really difficult for them to fulfil that funding gap. So you could bring those three things together. How do we have the pension funds contribute to the infrastructure needs of this country, and in so doing drive economic growth and growth in jobs? And, it's a paradox that, we think can come together under a model we're calling the pension-public partnership, rather than the public-private partnership, a new form of P3, where pension capital invests in infrastructure in partnership with the public to create that growth in GDP and in jobs. The case study in a country that loves case study for us is the Indiana Toll Road. where we have a 36-year concession there, and we've invested more in the last 12 months than has been invested in that toll road since it was built in 1950. And in so doing, we've improved the road surface, we've reduced the traffic incidents by about 30%, therefore there's less congestion, therefore there's more people using the road, therefore there's better revenue, and it's all come at quote-unquote at no cost to the Indiana taxpayer. That was from the former governor, the now Vice President, Pence. And so it's a great example of this pension-public partnership actually, in our case, driving great returns for our investors, but also in a responsible long-term manner adding to the community, and it's a pretty big community, the safety, and adding to the returns at no cost to the taxpayer. And we'd love to see more of that case study emulated throughout the country at a time when the country is clearly looking to private sector to partner in the infrastructure needs of the country.
So let's think a little bit about business models. I'm going to turn to you now, Scott. Sure. If you hear that in this infrastructure opportunity, this is for pension capital, it's longer-term patient capital, there's clearly a need to match the assets and the liabilities for the investors and the savers over a longer life cycle. Your business model is a little bit different when it comes to the investor side, but why don't you share with us how do your investors and how do you think about your business model there, and then let's find a couple of case studies as well.
Sure. So maybe just to give you a little bit of perspective on sizing to start with, so you have a sense of when we're talking about the venture capital industry. In the U.S., the venture industry raises somewhere between $30 and $40 billion a year, roughly, from institutional investors, and invests about $50 or $60 billion. So when you think about this in the context of other asset classes, hedge funds, for example, in the U.S. are roughly $3 trillion in assets under management. Private equity probably invests order of magnitude $250, $300 billion a year in the U.S. in terms of buyout. So venture is a very, very small slice of the overall pie. And to Brett's point, many of our investors have the same overall financial goal that his do, which is they have to be able to kind of beat, CPI and earn a rate of return over time. And the way they think about kind of venture capital in the context of an overall portfolio is very high kind of alpha generating assets. So at scale, if we do our jobs right, we ought to be able to return, kind of 25% net IRRs back to investors, right, over, long periods of time. So these funds are often typically 10, 12-year funds. But if you can think of venture capital in the context of a broader portfolio, you have, listed equities, you probably have infrastructure components. Venture tends to be the kind of very high alpha and high return generating asset class that people are looking for. So the leverage, hopefully, that venture capital brings is, despite the fact that it's relatively small dollars, it actually accounts for a very significant amount of job creation and actually market cap creation in the U.S. So if you look at public companies today, almost a quarter of the market cap of public companies today originates from venture-backed companies, and about 50% of the research and development spend in the U.S. also comes from venture-backed companies. So you've got an asset class that's very small in terms of nominal dollars, roughly about 0.3 of a point of overall GDP in the U.S. here, but that's kind of contributing in a very outsized manner both to institutional investor returns as well as to growth opportunities in the U.S.
Mm-hmm. Going a little bit to the case study, you are part of the Silicon Valley ecosystem, so to speak. It goes way beyond Silicon Valley.
Right.
There's other parts of the country. I live in New York, and there's now a lot of startup and venture capital in Brooklyn and in Chelsea. So we're seeing in New York trying to claim credit for it these days, as they always do. But when you go to the Silicon Valley ecosystem, what was the original Silicon Valley ecosystem, as well as the venture capital, started more with hardware.
Yep.
It was memory. It was the speed. It was very different, but it shifted. So I think it'd be interesting for those of us here to understand a little bit more about how has the Silicon Valley shifted in the last 25 years, and what were the original investments of your firm, and what are the kind of things you're looking at now?
Yeah, so it's interesting. The name itself, Silicon Valley, obviously harkens back to an era where literally it was silicon chips. So think about that as companies like Intel and others, obviously building fundamental building blocks for servers. I think what's happened over time, and the reason I think venture capital has moved more towards kind of software-based assets versus hardware-based assets, is really a reflection of what's happened in the computing industry. And if you think about that at a very high level, people started with very large physical servers. Obviously, before that, we had things called mainframes, of course, that in many cases still exist and still run vital applications today. But as the cost of a lot of those hardware components have come down, more and more of the intelligence in applications has been written into software. And so software, in terms of its strategic importance and therefore as an investable asset, has grown very, very significantly, really over the last probably 15 to 20 years in Silicon Valley. My partner, Mark Andreessen, kind of coined this phrase called software eating the world, which is really just a fundamental idea of thinking about how automation and software is continuing to permeate more and more traditional industries. So if you're a Netflix viewer, right, Netflix has kind of eaten the traditional content delivery model for Hollywood. Or if you're an iTunes user, right, you think about how iTunes has changed the traditional music industry. What we're seeing more and more is software taking on more traditional industries. We mentioned life sciences. You and I were talking about financial services in some respects. So there's lots of examples of kind of software really kind of, quite frankly, becoming the predominant venture model, particularly in Silicon Valley these days.
I want to ask both of you a question to get some dialogue between the two of you. One of the goals of venture capitalists is the so-called exit.
Yes.
And it's when you want to find a buyer or someone who's going to take a company to a new level. It's a new sense of who's the capital that's going to be involved in the capital structure. Moves from venture might run into different rounds, and then eventually maybe the exit is an IPO. So how do you think about the IPO market? It's actually slowed down a lot. There's a lot of companies that have been holding back, that have not been doing IPOs. There could be various reasons for that. And then the flip side, you're an investor. You buy listed equities. One of your business lines is listed equities. I'd like to hear your point of view about the exit and how you think about that, and then your point of view as an investor. How do you think about listed equities, and what are some of the dynamics that you pick up?
Sure. So in the U.S., probably the most significant thing that's happened in the U.S. over the last 15 to 20 years is a change in the IPO market, as you mentioned. If you think about it, over a long period of time, we used to have about 300 or so IPOs a year, pretty consistently from about 1980 to kind of early 2000s. Over the last 15 years, that number has dropped in a third, so we now have about 100 IPOs roughly on average a year. And the nature of those IPOs has also changed, meaning that we used to have what were called small cap IPOs. So companies that might have $500 million market cap was a very typical size of company to go public. That was a bit more than half of what the IPOs used to look like. Today, fewer than 25% of the IPOs actually qualify for what you would consider small market cap companies. And so what you have is really a couple of phenomena happening, at least in the U.S., is fewer numbers of new companies going public. At the same time, you also have lots of companies kind of being either delisted or getting acquired in the U.S. And so what a lot of people have talked about and written about is the fact that over the last 20 years, the number of publicly listed companies in the U.S. has shrunk by almost 50% over that time period. So you have what at least we all think is a very serious issue, in part because we know that IPOs obviously facilitate job creation in the U.S. And so one of the certain priorities for us from an economic growth perspective is facilitate job creation. It also has shifted more and more of the gains of a lot of these companies into the private institutional base as opposed to public market investors. And so, there's a number of issues that this creates, but certainly an area that we're focused on in order to facilitate better, IPOs and hopefully more capital formation in the U.S.
A number of comments from our perspective. We manage money on behalf of those workers around the world across listed markets, unlisted markets, active and passive. So we've got a view that it covers all of those different spectrums. So in the passive business, it's clearly a quantitative decision. But in the active business, both in the listed and in the unlisted markets, so listed equities globally and Australian, as well as clearly unlisted markets like infrastructure. Broadly speaking, we have a view that we're buying a company or buying a share of a company, not just a security. Mm-hmm. And so with that, and then matching that back to our investors' expectations, which they, generally speaking, want to be long-term responsible owners, because they believe that in being long-term responsible owners, you'll add to the enterprise, which will clearly enhance their returns. Now, that's more or less relevant in the different asset classes that we look after. In the case of infrastructure, our view is most simplistically, and we like to try and make the complex simple rather than the simple complex. Our simplistic view is infrastructure is a long-term asset class. And in order to optimise the value of that underlying infrastructure asset, you need to manage it and treat it and set the strategy up accordingly. You know, we're one of the largest owners, or we are the largest owner of airports in Australia. And for anybody that's flown out of LaGuardia and flown into Melbourne, tell me how your customer experience compares. We like to ensure that the customer experience, the jobs that we create, the safety of the workers is fundamentally better as a result of our ownership. Because again, it comes back to our simplistic principle that it's a long-term asset class, and the more we can do to enhance the attractiveness of that infrastructure asset, the more revenue, frankly, we'll generate, the better relationship we'll have with the community, the better relationship we'll have with regulators and government, the bigger licence we'll have to invest more money. And that's what we want to do on behalf of our pension funds in Australia and in this country. So it does vary, Doug, across the asset classes, but in general we have a view that long-term responsible ownership is the way to drive optimal value for the underlying people who we represent. And in the case of infrastructure, we therefore intend to own those assets for the very long term. The concession on the Indiana Toll Road, back to that, is 36 years. We expect that we'll own that for the next 36 years to go, for the next 36 years. So let me know how that goes.
I have a question for you on going back to the infrastructure theme then. When you think about infrastructure, and similarly to venture capital, we talked about both of these are ways that create jobs. There's a very important component to these types of investments that create jobs. They're jobs across many different types of roles. It's high-paying, it's well-paying jobs, and therefore different types, blue-collar, designers, engineers, lawyers, etc. So one of the arguments in favor of infrastructure in particular is the multiplier effect, that infrastructure not only creates the jobs that when you build and design the infrastructure, but the operation goes on. I'd like to understand from your case study, so to speak, let's maybe talk about airports. Do you have facts that show that infrastructure creates more jobs than the infrastructure itself? What is the multiplier effect that you guys see in your investments?
Yeah, so there's a couple of ways in which I'd, if you don't mind, like to address this. There is the direct multiplier effect, and yes, since we've owned Melbourne Airport in the early 2000s, we've created 8,000 direct jobs in the Melbourne Airport facility. Then there's the multiplier effect. As a result of improving traffic volumes through that airport, there is clearly an impact on the state productivity, in that case of Victoria, and indeed the national productivity of Australia. And that multiplier effect is somewhere in the vicinity of about 1.2. So we have, as investors, actually therefore put more money back into the airports than we've taken out as dividends, because it's frankly in our investors' interest to keep investing in that enterprise because it's adding to their returns. The other thing that I'd like to just touch on in terms of jobs growth, if you don't mind, is that we're also very conscious of the administration here's focus on both infrastructure and the desire to create both growth in jobs and growth in GDP. One model that we're also advocating, to be quite frank, is what's called the asset recycling model. It's probably not the greatest terminology, to be frank, but it is where existing public ownership of assets is leased, not sold, in full or in part to a long-term responsible investor like an investor that's representing pension fund capital, dare I say IFM, and others. The proceeds of that the state owner receives is invested back into creating new social and economic infrastructure, which also creates those jobs that you're talking about. So we will not direct, our capital will be used by the vendor, who is a state entity, to invest in the new hospitals, the new schools, the new roads that either the muni bond market isn't able to serve, or their other financial options aren't available to them. So that's above and beyond the direct impact of our ownership of infrastructure assets. There's also the opportunity to consider, frankly, monetising through leases, long-term leases, of some of the state-owned assets to enable those state governors in this country to then invest in the infrastructure and the jobs creation directly and indirectly that comes with that short-term construction, as well as the long-term productivity enhancements of better roads, better schools, better hospitals.
Great. Continuing with this theme on jobs, and let's go to you, Scott.
Yep.
One of the conundrums of many economists these days is to measure employment levels. Obviously we've reached a very attractive unemployment rate of 4.3%, but at the same time, labor participation is an all-time low as well. And some people are scratching their heads because there is wage growth, and some of the formal economists have been doing studies about the gig economy. Are we missing some of the employment or value creation that maybe isn't getting counted in the right way? Some of your investments like Lyft, and I believe you're also in Airbnb, have created new ways for assets to be utilized, for a car to be used more than just for transportation, to also become a way to generate income for your spare bedroom or for your spare apartment, to be used to generate income. How do you think about that, both from the point of view of maybe investments, but then also what about the job creation, and what are we seeing with this gig economy? Yeah,
I think there's two related issues, actually. One is exactly as you described, which is this idea of the gig economy. And for people who may not be familiar with the term, the idea is really people who are effectively kind of, their own independent contractors in many respects. And so as opposed to being a full-time employee for the company, they are able to set their own work hours. They obviously, in many cases, such as in the Lyft case, they have their own asset, their own car that they're bringing to the workplace. And I think you're right, which is if we look at all the numbers, most of the job reports tend to underestimate that because they definitely don't go through the same survey methodologies that they use for traditional employment. So at least as we see things in terms of where we're investing in technology, our view is that is going to continue to be an increasing portion of job creation over time. And it raises, quite frankly, material policy questions too, as to how do you handle those employees with respect to taxes or benefits or other things. And there's certainly some discussions happening in that area. I think the related topic, which also goes to job creation, is the changing skill sets required for many of the new jobs that probably will, quite frankly, dominate the U.S. economy over the next 30, 50, 100 years. And, we certainly see in many of our companies that they have tremendous kind of hiring requisitions that go unfilled for very long periods of time for very significant engineering and other related jobs. And one of the things I think that, quite frankly, we could all do better, as an economy here to facilitate job growth would be to think really more critically about job, retraining and re-education training to make sure that the skill sets that in many cases kind of prepared people for jobs that in some cases are being automated through some of the technological innovation we have, that we redeploy those resources in ways that could actually be very productive in the kind of, more software and automation-based economy that we're probably moving to over time.
Mm-hmm. I have almost a little bit of philosophical question for both of you. It's ironic that in an economy that is so gung-ho about starting up and being able to fail and getting the capital to get your business moving and going, and the entrepreneur spirit, the go west young man, let's go to Silicon Valley. At the same time, we have a resistance to private sector ownership of infrastructure. It's a little bit of it's a dichotomy in an economy with that sort of spirit of entrepreneurship, and then the flip side is we kind of resist the government giving up ownership of things like airports and ports. Do you have thoughts about that? I think both of you are representing different investors that are related to that. And I think in your case, in the infrastructure, it's something we've got to think about as we come up with a more modern infrastructure model.
Yeah. You're right. There are, unfortunately, a lot of examples where private sector ownership hasn't been good to investors and it hasn't been good to users. And we understand that. And that's a reality. The other reality is that in order for, frankly, this country to invest in the infrastructure that's required, according to the Engineers Society, it's D+. There is a massive investment that's required, and the federal government has clearly said we don't have the money to do that on our own. one of their 4 principles that was announced in their budget paper last week, or the week before last, was partnerships with the private sector. So there is the economic reality, and I think everybody gets the economic reality. However, there is also the public sentiment that now has to be better understood and, frankly, appropriately managed. And that's where we think, there are a range of potential options as to how the private sector might play a role, one of which is, as I said before, that pension-public partnership. And the logic for us in positioning that is that it is, if you're representing workers' capital and you can show the benefit to the workers because of the impact on their retirement savings accounts, because we're managing money for 70 of them in this country, and you're also net creating jobs for workers because you're owning these assets for a long period of time, and you're improving safety for workers, that's a very different form of private ownership than what they might otherwise be perceiving is the case. Yeah. So we know that in other countries where that has happened, politicians have been re-elected. Believe it or not, politicians have been re-elected on a privatisation platform. The most prosperous state in Australia at the moment that has had 11 successive quarters of GDP growth ahead of the rest of the nation is the state where the governor, we call them premiers, was re-elected on a platform of privatising the electricity transmission and distribution assets. Believe it or not, he's coming over in a few weeks to tell the story to the governors. That state yesterday reported it's a $12 billion fiscal surplus in its budget after it's invested in creating hundreds of thousands of places for new school participants at secondary and primary level. So the point is, and he was re-elected on this platform of privatisation, but what we would call the public pension fund partnership. Lease it, don't sell it. Lease part of it, not all of it. Recycle 100% of the proceeds back into new schools, new hospitals, new roads. Partner with long-term responsible capital, not some other forms of capital. And also get the federal government incentive of 15% to add to the sale proceeds that he otherwise got from people like us. And that has changed the national debate. And as a result, the community is happy. The community's got more jobs. They're getting into schools easier, getting into hospitals easier. Investor returns are going up and politicians are being re-elected. So, yes, we recognise that there are real challenges in the community support. Everybody, well, not everybody, but most people understand the economic rational argument. It's how do we impact and influence with substance the sentiment of the community and indeed their elected officials. And there is another way.
Yeah, I completely agree with everything you said, and I think what's happened in the States, right, is we've always had this very hard line between private and public, right, and I think people have thought about things like roads and highways and airports as almost, quite frankly, public goods in many respects, and I think you're right. What we haven't had are the successes in this country to show that privatization itself is not a bad thing, as long as you have the proper role with government and regulation and other things to ensure that, we're not just talking about pure profit-seeking activities on behalf of the private sector, but we're talking about a partnership that actually does reflect, a reallocation and quite frankly, redistribution of some of the income that comes out of these projects to help create jobs and do other things. And again, you know from having been here for many years, right? I mean, if you talk about privatization of things like Social Security or health insurance, of course, in the U.S., it creates tremendous ire among people. But I think particularly in the infrastructure space, if we can highlight some of these kind of well-functioning use cases where we actually have privatization that's been done in partnership with the government, and government both federal and local, I think people would start to see that this actually is a real opportunity in the U.S. that can accomplish all the goals we've talked about.
One of the most important emerging trends that we see in our business relates to demand from investors for more information about environmental, social, and governance data, analytics, statistics, et cetera. I think this goes back 5 or so, 10 years ago in Scandinavia. It started there from what I see, and it's slowly gone around the world, becoming much more important in Australia, in the UK, in Switzerland, in the United States, et cetera. we're developing products ourselves where we have indices that are low carbon, no carbon. We have infrastructure indices that take these into account. We have launched a green rating, which looks at the long-term green viability of investments in bonds, et cetera. But what are you seeing in infrastructure field? How much demand are you seeing from your investors, and how have you been seeing more modernized environmental and social and governance capabilities? And then from the venture capital point of view, what sort of opportunities are you seeing, and how many of the investments that are coming across your desk are related to this field?
Well, I don't want to complicate it, but our investors have been, certainly in Australia, which is where we've obviously emanated from and where our largest pool of capital, if you like, resides. It is critically important to them. And it has been for a long period of time. And so it is very much a part of their DNA and very much a part of our investment decision-making process. So if you're going to own a port, as we intend to, for 99 years, you need to understand the impact on the environment and the potential impact on sea level rises and what that's going to do for your port. Will you have one in a few years' time, or will it be underwater? And what capacity do you have to influence that in any way, shape, or form with dredging or whatever else? So the broad point is that it's been critically important to Australian investors for many, many years. I would say that the Europeans, and in particular the Nordic investors, lead the way in really embracing ESG. And with great respect to the US pension funds and North American pension funds, it has been not as strong an issue, but it is really growing as an important issue for the US pension fund sector, really growing. And clients are very focused on what we're doing environmentally, socially, and from a governance perspective. We'd also add another S in there, environmental science, environment, social and science. The impact of technology on science on these long-term assets. What are driverless cars going to do to toll roads? What is the change in retail going to do to the physical retail networks that are in airports? So in answer to your broad question, very important issue, fundamentally impacts investor returns, so it has to be a focus of the investment decision-making process, and it is a growing issue with the institutional investors in this country.
Yeah, we've seen also in the U.S. here, particularly in the endowment and foundation portion of the institutional investors, it hasn't impacted venture capital per se in many cases, but most of our endowment and foundation clients have some type of ESG policy, and in many cases have done certain things of either divesting out of particular assets that they believe aren't consistent with that. I think the opportunity, at least hopefully, is that venture capital and hopefully aspiring entrepreneurs can actually help address some of these issues through technology. So, we saw in the U.S. A significant amount of venture capital investment geared towards the clean energy space over the last 10, 15 years. Unfortunately, I'd say the track record on that was pretty mixed. I think in many cases probably because just the maturation of the technology wasn't where it needed to be. And many of those businesses kind of relied on government subsidies in many cases in order to be able to kind of fund what were otherwise difficult margin structure businesses. But with the change in technology, particularly if you look in the U.S. here with, the shale revolution and what's happening in terms of, oil prices, I think there's probably a real opportunity for, quite frankly, technology to continue to have a much bigger impact on ESG than it has historically, as the costs of a lot of these inputs, in particular, as you look at kind of, energy reliance and others changes over time, hopefully in large part to increasing sophistication of the technology.
Are there any trends in what you see coming across your desk? What are the proposals? When you look at them, do you categorize them, or is it shifting over time? So what are the things that we should be seeing coming out of the venture capital world? And if you use that as a window into the most cutting-edge innovations, what should we be expecting?
Yeah, so we view our job as getting ourselves in front of hopefully the most interesting entrepreneurs who are doing cutting-edge stuff, as opposed to us thinking that we're smart enough, quite frankly, to see all the trends. I will tell you, based on what we're seeing, though, today, tremendous area of excitement around life sciences right now. So we do investing in what we consider the intersection between computer science and life sciences. And if you think about the current generation of biologists and medical practitioners, and many of whom are kind of finishing their education and going into the work world, most of them grew up actually programming computers. And so you've had this natural kind of almost drag of computer science and engineering into, kind of an industry that's a very obviously heavy data intensive industry. And so we're seeing companies using things like, artificial intelligence to help better predict or diagnose early-stage cancer, or if you have cancer, to better predict which drug treatments might be most effective, again, based upon using kind of artificial intelligence algorithms to help inform that. So the application of artificial intelligence more generally to industries, I think, is probably the most exciting thing we're seeing. As I mentioned, life sciences is an area. We talked a little bit about this, financial services. You're seeing people try to come up with new credit scoring models, people coming up with new kind of, asset classes, again, based on this idea that computers have gotten very good at being able to take very, very large amounts of data and obviously derive insights from them in a way that just, hasn't been able to happen over the last, 10 or 20 years. And some of that is just a function of, again, the maturation of technologies that, quite frankly, are, older historical technologies. Things like artificial intelligence have been around for very long periods of time, but we haven't had compute power and data at the levels that we do today to be able to actually make them real. So we're continuing to look for those types of opportunities across, quite frankly, any kind of horizontal industry.
Brett, I'm going to ask you the last question before I give a final wrap-up. We have an audience here of investors from around the globe, and one of the topics of this conference is to think about why the U.S. You're an international investor. You're coming from Australia. What do you think about the U.S.? Why the U.S.?
Thank you. Well, very attractive. Would frankly love to do more, because I think Secretary Mnuchin mentioned it earlier on. Amongst other things, as long-term investors, we can be confident about the rule of law, and contract enforceability is really important. So this country prides itself on creating a strong and stable environment for investors, and so. As a result, we have a reasonably significant range of investments here, and like others, would be more than happy to take up the Secretary's offer to try and invest more in this country, because we feel that the environment is very supportive. The outlook, whilst there might be short-term blips here and there, like there is in every economy, long-term, this is an attractive place to invest, and we, on behalf of our investors from Australia and the US and globally, hope to have the opportunity to do much more of it.
Thank you, Scott. Thank you, Brett. I want to thank all of you for listening to us. I think we've touched a broad range of topics related to the increasing opportunities in the United States for investment in infrastructure, the dynamism of our economic system related to our capital markets, kind of funding available, the patient capital, whether it's for investing in the internet economy, in the growth economies, in life sciences, in financial markets, or the consistent long-term investment in infrastructure, and the kinds of conditions that make this a very attractive economy to invest in, and the sort of opportunities that are coming in infrastructure, and all of the new opportunities that will come with the changing landscape in the startup area. We appreciate all of your participation. On behalf of Select USA, I want to thank our panelists this afternoon, and please enjoy the rest of the day. Thank you.
Thank you.
Thank you.